In today's video, we are going to discuss in detail an approach to trading the market via the SPY ETF, which represents the S&P 500. I've both seen and received feedback from traders recently that they're struggling quite a bit. And this is unusual because when market volatility goes up, short-term traders' P&L generally goes up as well. We have taken 2 hours of our training and created a free workshop for you. In that workshop, I go over our stock selection process so you know the best in-play stocks to trade each day. In addition to that, we use 3 of the best risk-reward setups that we teach on our desk in New York City, both from myself and Mike Bellafiore. If this interests you, click on the link above and it will open the registration page to the free 2-hour webinar, and it won't close this video, so check it out now. Today we're going to talk about trading the market. And when we talk about trading the market on our desk, we do that via the SPY ETF. It represents the S&P 500. We trade several market ETFs. You also probably heard of the Qs, which represent the NASDAQ 100, the IWM, which is a broader index. But my main focus is the SPY. It's been the SPY for many years. This is the large cap stocks. It's an index ETF that many large hedge funds use to hedge off their positions, to make bets on the market, both via the ETF and options in futures contracts. And I think is a relatively good gauge of kind of what the bigger players are doing. And I find that of all of them can be the easiest to read. So I want to take you through some points of things that I look for and things that I do before the market even opens in terms of that prepares me to trade them. And what I view is ways that I can lower my risk and raise my reward each day in that approach. And as well, when I go through this, we also have a junior trader sitting in the room who's also looking at the SPYs every day, looking at the market, evaluating it versus potential trades that he's going to take. And perhaps he'll have some feedback in his own process or ask me questions as we work through some of these trades. So the first thing I want to point out is we want to establish before the day begins what is the type of day we're looking at. Are we setting up potentially for a large trend day, or are we looking at what would be a range day? Most days we know are range days. During the course of the month, you might have 2 or 3 trend days. So for the most part, your preparation is going to really be about what is the expected range for the day? Where are the major resistance levels? Where are the major support levels? And kind of based on recent volatility, what are we looking at for an expected range? The second thing is the key support and resistance levels, which I kind of alluded to in my first point a little bit. But before the market even opens, if the market's going to open at level X, I have levels, $1 above that, $2 above that, or $2 below, where I know I'm going to look for the market to potentially support or resist and turn in those areas. The third thing, which I guess I alluded to as well, is the expected range. We'll get into that in a little bit more detail. Trading off key levels. It's very important when the market's moving around so much. Quite often what we'll see from traders, and the less experienced, the more often we'll see this, is they'll see something on the tape. They see a buyer and they see a seller and they throw a trade on. But the truth is that we want to pay attention mostly to things on the tape when it's near important support or resistance. Otherwise, we lose the forest for the trees and we start to overtrade. And before we know it, we've made 5 or 6 trades at prices that aren't important. We get ourselves in a little bit of a hole, and perhaps when the really good trade sets itself up, we're more reluctant to take it. So very important to keep that in mind. And then finally, we want to go for singles and doubles. When we know that the ranges are going to be pretty wide in the market, and we know that generally the market is going to have 2, 3, or maybe 4 significant moves on an intraday basis, we don't actually have to capture a massive one-way directional move, because if there's 3 to 5 pretty good setups in the market during the day, we want to take profits quickly on part of our position and be in a position to continue to book profits on the next trade that sets up, and not be dependent on the first trade we take or the second trade we take being the one that's going to work perfectly. And so we'll get into that a little bit as we go into the example. So there's kind of my bullet points as when we're going through here. So here's some pictures for you to look at. When we talked about ranges a little bit earlier, the way that I like to do this is from a big picture perspective. We know that the market overall, the S&P, the SPYs are in this range between 280 and 260. And we know when it makes a big move off the top of the range or off the bottom of the range that things will then compress. And so when we're looking here at, I think this is a 30-minute chart, and you can see on the left side of the chart, we sold off pretty hard from the 280 resistance over a course of 2 days and came into the low 260s. And you can see I labeled each day what was the range. In the first one, it was an $8 range. Then the second day was a $7 range. When you have a really large range like that in the first day of $8, and then you see $7, what we start to think about is compression. Now the interesting thing was on the third day, and I don't think we've seen this at any other 3-day period this year, I'm pretty sure. On the third day, when we gapped higher, I was looking for some compression, but what actually happened was we ended up rolling over again and closing at the lows, and we had another $8 range. And so that set us up for the following day where we flushed through the longer term support and got back above it. And then that was the beginning of the compression that we've seen over the last few days. And so since we took out the 260 low and reversed and had that $6 move, at that point, what we started to think about and talk about in our morning meeting was, okay, we had these big down moves. We reversed off the low. Let's see if we can get some compression. The move off the low was $6. So the next day we said, okay, let's look for a range of 4 or 5. And then yesterday, I guess, again, we talked about 3 to 5. And then today we were actually thinking maybe we'll even have a sub $3 range. I haven't labeled it yet. The day wasn't over when I made this chart, but we're looking for compression. And as we look for compression, it's easier for us to develop what are the support and resistance levels going to be, because we had the bounce off of the low. We know that 2-day bounce off the low, that's going to start to be a resistance area. And then the pullback the day after the low, that's going to potentially be support. And then when we move forward in time, the support and resistance are going to get closer and closer together, and we're going to zoom in on the 30-minute chart and kind of develop our ranges. So I want to take you into coming into today, what we were looking at. So here was our starting range for today. You can see that yesterday at the end of the day we sold off pretty hard from 268 all the way down to 265.5, 266 or so. And you can see right in the afternoon, I highlighted on the left side the second blue line from the top. On the left side, we spiked up into the close. We're looking at a 30-minute chart here, so it's not very granular, but you can see that as we were coming off, there was one spike up to just above 267 to 267.25, then we closed really weak. And then I have a band at the bottom, which is 265 to 265.5. The after hours low was 265. When we came in this morning in the pre-market, there were buyers at 265.5. And so what I'm doing is I'm using prior days levels as well as pre-market and overnight levels to develop important prices for today coming in for the open. And then I'm also using the prior chart where we talked about compression of ranges. And we went from 7 to 6 to 5. I think yesterday was a $4 range. So today, my thought was, well, maybe we'll have our first sub 1% day in a while from an intraday perspective. And that would kind of give us a range, what I highlighted for right here, which was 265 to 267.5. A 1% range on the SPYs right now is about $2.65. And that range that we're highlighting right here is $2.50, just below 1%. We didn't necessarily have to have that range. We could have a little bit bigger, maybe $3, 3.5. I thought worst case was 4, matching yesterday's range, because again, we're still in compression mode. And so until the market can show me that we're going to expand outside of the recent prices, I'm not going to be looking for larger ranges than we've seen over the last couple of days. And so what I'm doing, once I have this range established, and what we talked about in the morning meeting is I'm just going to fade. If the first move is up to the top, I'm going to look to fade into 67 or 67.25 right there. And then if the first move is down into 65, 65.5, into that little area, I'm going to look for support there to fade that and make trades. And that'll be kind of the way I look at it for the open. Now, like anything else, when we have a fresh in play stock, we'll gather more trading information in the first hour, hour and a half, and then we'll kind of update our kind of expectation for the day based on what we're seeing. Were buyers really controlling in the first hour and a half? Were sellers really controlling in the first hour and a half? And that's going to kind of update how we trade a little bit from there. And so let me walk you through a few examples of trades that we took on the open, as well as I'll go into the afternoon, potentially if we have some time, and give you my thought process going into the last hour, and we'll go from there. So here's the first trade. So first trade right on the open was we spiked up, and so I highlighted 2 points for you, point 1 and point 2. So I wanted to kind of tell you what I was thinking there. So the blue band there is kind of my area where I really want to be short. And the other thing that I'll do, if we don't get to my band, if I notice a seller when we're getting close to the band, and we fail, and that's point 1, we failed there a little bit below the band, and then we came down, when we come back up to where the seller is, I'll actually initiate a very small position right there, because what I'm doing is I'm using my tape reading skills to say, oh, it didn't quite get to that 267 to 267 and a quarter, but it was pretty close. There was a seller at 266.85. It came off 40 cents there. If it pops back up, I'm going to look to see if the seller's still there, or even short a little bit. That way, if that ends up being the high of the morning and it rolls all the way down to our 265 support, at least I have a little something. And so it came back up there. I put on a little bit of something, and then boom, that seller lifted. I got much better prices into the quarter, and then it quickly got below you can kind of see it got below our band there, and then the trade started to work. At which point, what I really wanted to see were 2 things. Number 1, I wanted to see it get below 85 cents where the seller was originally before it had that quick spike. And number 2, what I wanted to see was some sort of consolidation near the morning low and a break to the downside. That's why I highlighted that area there with about 5 or 6 bars in the middle of the chart. And so it actually was one of the cleaner trades we've seen in a while. It was pretty, there was really not much pain at all. So just so you know, like if we zoomed out to a 5-minute chart on this, this is like, we didn't even have 1 bar close above 267. So this is about as clean as it gets in terms of you got a failure right where you were looking. It came down about a half a point, and then it moved sideways for about 5 minutes and then broke to the downside. The other thing that I like to do is when I'm shorting into this pop into 267, if it very quickly reverses and comes below 267, because I don't know if this is actually trade's going to work, is I'll immediately cover 25% of my position. And then as it comes into the lower prices, and if I notice there's buyers supporting near the morning low, I'll cover more, but I'll be open-minded about it. If a seller steps down and that consolidation breaks to the downside, I may momentum hit it. And again, I'm looking at it from a position of strength. It failed in our short zone where we were looking for failure. It came down very quickly. The sellers stepped down. That's why we got a very tight consolidation there in the middle of the chart. And then it broke to the downside. But either way, whether or not I add back to the position or I hold what I have from above 267, it's going to be a good winning trade. And so in this case, the other thing that I talked about when we went through the bullet points is I'm not necessarily married to the idea that it has to completely reverse here and then go down to the support areas we're highlighting in our range for the day. If it retraces back down just to 266 and they show some buying there, I'm perfectly happy to get flat the trade and see if it then runs back up to 267 again and do it again. And maybe the second time it'll take out this pullback low and we'll work our way down to 265. So that's the example of the first trade. Here's the second trade. So you can see on the left side of this chart, that's the area where I originally shorted for trade number 1. Then it came down, and you can see popped back up the second time pretty cleanly right to 267, and that's where I'm initially entering the trade. And then you can notice that when I entered there, it immediately pulled back from 67. There were other offers up there. People were probably shorting it into 67 because of the hard down move that they had just seen on the open, and it pulled into 70 cents. And what I noticed for the next few minutes was someone was just buying it at 75 cents, and that it probably was going to at least retest where I just shorted it, or maybe even spike to the morning high. And so I was very careful in terms of how I entered into this trade, in terms of not putting on any size until it tested the morning high as well. And so that's point number 2. So point number 2 is kind of where I added the bulk of my position. And I should point out to you, when I was putting the short on above 267, I knew above 267 and a half was my out. I was trying to risk an average of about 30 cents. I was trying to get as much stock as I could above 267 to basically make my average risk less than 30 cents, so being from an average price of 267.20. And then the upside, obviously, to the first pullback low, and if it failed there, maybe it would come in closer to the bottom of our range for the day. And so in this case, and I think, again, we're looking at the 1-minute chart, and you can see it was very quick. It just spiked up, took out the morning high, and then within 2 minutes was below the original high of 267 and a quarter. A few minutes later, it was below 267, and again, it just started to work pretty easily. It did move sideways for a little bit in the 266.70 area. I've highlighted that as point number 3. The reason why this was important, and I think I said actually on the desk to you, Jeff, if it gets below that 70 cents, this is when the trade's going to start to work, because that buyer that I noticed when I shorted it at point number 1 was they stepped in there and they caused that little final spike to put in the high. And I said, if you're a more conservative trader, and this is for you, I'm talking to you, if you didn't want to short just into the strength at 67, and this is probably you, is like, you want to see it fail at 67, you want to see the buyer at 266.70 drop, and you want to hit it there and risk 20 cents. And that's fine, because it's actually, from a percentage standpoint, it's probably a higher percentage win rate, because you now have the wind at your back. It's basically gone up, it's trapped some people who got long above 67, above the morning high, and then the person who was supporting it, buying it at 70 cents, which caused that last 50-cent spike, is now gone, and people are going to start to hit out. So even if this isn't the beginning of a big down move, you'll get that momentum of 20, 30, 40 cents to the downside. And if you hit it below 70 there at like 65, you're going to get probably covers at 50, 40 cents, cover your risk. You can put a stop above 267 at that point, and then see if it trends down through the morning low. That's actually a more traditional, for me, I think one of my strongest things is I'm really good at identifying the prices where things will likely reverse and fail. And I'm comfortable with that. But for most traders, the majority, they have an idea where they think maybe things will fail, but they're not that confident in the prices because the market's just very volatile right now. But when they see the failure, and then when they see it start to reverse, they're very happy to just pile on in the reversal momentum. And this goes in either direction, especially on the short side. Short-term traders like to be short more often generally, because stocks generally go down more quickly than they go up. That's usually the reason. So you see the buyer drops there, it goes down. Looks like about 40, 50 cents. I can't see the chart from where I'm standing that well, but it goes down about 40, 50 cents. And then what you want to do is when it spikes back up, of course, we always know, everyone knows support becomes resistance, resistance becomes support. If it spikes back up close to 70 cents and you've just caught that quick 50 cent down move, short it right back into the 70 cent level. It's only 10, 15 cents a risk, and then maybe you'll catch the beginning of a trend. And so the second trade ended up, even though there was a little bit more pain in terms of the spike above the morning high, it did reverse quickly. It did give you a second entry. Oh, and this goes back to my point earlier in terms of not wasting your time reading the tape at every random price, which is if our starting range for the day is 65 to 60, 67 and a quarter, kind of where it failed the prior afternoon, which is a little bit over $2, and we can find a spot to read the tape in the top 50 cent of that range, less than within 25% of the top of the range we've established before the market opens, then that's pretty good. It's even better. It's even better if there's maybe it was a buyer at 266.90, which is even a little bit closer to the high, because it just makes the risk reward a little bit better. But even at 70 cents, it's close enough to the high of the day where you're still going to have a pretty good risk reward. Where it starts getting not good is when you start reading it, reading the tape down at 266 or 265.70 at prices that are basically in the middle of the range we've established for the day. And this applies in any time frame. General rule of thumb, and I teach this in our mentoring program. When we're talking about putting on risk, whether you're trading a 5-minute time frame, a 3-hour time frame, or a multi-week time frame, when you start to put on large positions in middle of ranges in your time frame, it's just a terrible risk reward. It's really how to just destroy your numbers overall. And so the same thing here. You really want to put on more risk when it's closer to a possible failure area or a possible reversal area. And that's based on established ranges, whatever time frame you're trading in.
Real quickly on that, the second trade, you do a really good job of recognizing the difference between what's happening in the first 30 minutes and then what happens after. And I think that this is a different trade almost, because that first 30-minute trade is a really quick trade that you do really well. And it's certainly not in my wheelhouse, but this is something where it's the ranges are a little more developed, a little more respected, we're thinking at that point. So I don't know if that's something that would be helpful to others, is even if you don't make the first trade, the second trade is even should be a cleaner trade, because we're trading it off the levels intraday in addition to the levels that that were there from the prior day. So it's
Yeah.
kind of lining all that stuff
Yeah,
up.
this is a really good point by Jeff, which is like in the first 15 to 20 minutes, we call that time period price discovery. And although we have some levels in the market based on some pre-market activity, some overnight activity, some prior day activity, until we see what the buyers and sellers are going to do in that first 30 minutes, we don't know if those levels are going to stick. And what we do know is on that first trade, it did fail at 67. It did come off over $1. And so when it comes back up there at 10 o'clock, or whatever time it was that it came back up there for the second trade, what time was that? I can't see from that. Okay, 10:15. So we know at generally like 10:15, that's the reversal time kind of in the market. We have this rule in traders where markets, they'll go up to prices or go down to prices around 10:15. And then if they fail there, you just get these nice reversals. And so there's more data. After 10 o'clock, more people come in, more buyers and sellers will come in. Things will get a little bit tighter. As we talked about, you got a little tight after it failed there. You got that nice tight consolidation. Sometimes you don't see that as much in the first 15 minutes. And as I was saying, it becomes a higher probability trade. And it's also because it's after 10 o'clock, and things are moving a little bit more slowly. You can see things a little bit more cleanly, and you have more data. It's no different than when we talk about these fresh in play stocks. Sometimes we have a lot of data from the pre-market, but most of the fresh in play stocks don't trade 10 or 20 or 30% of their volume in the pre-market. So it's a little bit of a guessing game based on where people have been positioned recently. And so it's the same thing here. Even though the SPYs is a little bit better than it's definitely better than a fresh day one in play stock, because we know that on the SPYs, price has memory from the overnight lows, and it does a lot of volume from 8 a.m. to 9:30, but it's still no substitute for once the market opens and you start to see people starting to commit millions of dollars and several million shares will trade, et cetera, as opposed to a few 100,000 in the pre-market. So that is a very good point. Thank you.
And more from the way you take profits on that too, because you're really fast to take profits in the first 15 minutes.
And that's a price discovery thing, really, which is I think when we were kind of developing the training program years ago, and we had to kind of just study and think about how we did things and how we viewed things. As I was looking at how the market moves in that first 15, 20 minutes, I called it price discovery. There's just no trends. There's violent up moves and violent down moves. And you see that quite often we'll take advantage of those things because we'll know that there was some buyers in the pre-market at X level. And we'll say, oh, you know what, if it drops to that X level at 9:33, let's buy there. And if it spikes up $1, just sell it very quickly, because we don't actually know, just because there were buyers at 9:32 at the pre-market support, it's not necessarily going to trend higher. In fact, by 9:37, it could drop that level and trend down for the rest of the day. And so it's very important the first 15 minutes to scalp trade. Even later in the day, we talk to the traders in this type of environment to scalp trade. Now, scalp trading a little bit later in the day, maybe that's more like you're in there for 10 or 15 minutes as opposed to 3 or 4 minutes. But it's the same idea, which is you're trading move to move, move to move. The times where we tend not to trade move to move is when the volatility is lower and it takes longer for our trades to develop. And if we're in from good prices, we want to try to capture a larger trend. And we know that with the lower volatility in the market, we're less likely to get wicked out. But whether we're trading the market via the SPY ETF or we're trading an in-play name or a technical setup, we know with these types of violent gyrations, you're going to be stopped out of a good trade sometimes. So you really want to trade move to move, especially when we're seeing the bigger ranges, the 5+ ranges. As it compresses, that becomes less and less of a concern. Okay, third trade. So third trade, I wasn't really gung-ho about the long, even though the shorts worked really, really well initially. And maybe that's because the second time we got up there at 10 o'clock and we had the hard reversal, I was like, wow, maybe we will overshoot to the downside. But in fact, we did come down to 265. There was a little bit of buying in the 20-25 cent area. You can see I circled that and put the 1. When that buyer dropped, it flushed there and went back up. And so what I did was I used the same basic tool that I used on the short trades, which was somebody was buying in the 20s, it flushed down to 65 and held and popped up. So when it pulls back down to the 20s again, that's where I'm going to be bidding. It's close enough to the low. Well, let's see what happens. Also with partial position, because that's not, it's not our best price. And then you can see 0.2 went right back up. I believe that's to 266. If I'm having a little trouble seeing from back. Okay, so it just got to 266. So it was about it retraced from 265 to 266. That's about all you're looking for, unless the market's going to be really strong today. If it was going to be strong, it'd probably take out 66 or hold up there and start to consolidate and maybe make a run at the highs again. In this case, it just popped to 266, came down to 65 again. Now the interesting thing here is I think again we're looking at a 1 minute chart. Okay, 1 minute chart. It comes down, and they're buying there in front of 265, so we definitely picked our levels well. But the one thing you don't want to see is the sellers stepping down. And so I circled that area there, and it's about 10 minutes, and the sellers are not lifting from, it looks like about 265.30-ish or so. And it looks like it's going to break, but it actually holds and pops back up. But the trade worked. It did go up $1 from the first pullback to 65. Generally in that first pullback to 65, if you're buying it on faith, you really want to have stops below 90 and 80 cents there, just because that last trend from the morning high was pretty strong and fast. And if you're buying then the second time it pulls back there, when it stays there, you have to understand, and I was buying it there, but I was like, this probably isn't going to work. And just understand that you need to have your stop below 264.80. You don't want to risk too much there, because the sellers have now been in control for about an hour or so, and the concern is it could actually roll over. And we were talking about it potentially having a $3 to $4 range today. 4 would be the maximum based on yesterday's range. 3 being the one we were targeting initially for another day of compression. And at this point at 5, we're only at about a $2.40 range for the day. And so there really was potentially another dollar of downside here. And so that was kind of my thought process. So those are the 3 trades. A couple more things I want to talk about. Number one, I asked a pretty experienced trader in the chat today, was there anything specifically he thought I should talk about in the SPYs? Was there anything that he was doing recently in the SPYs that was helping his trading? And I found his feedback to be very interesting, so I just screenshotted it and shared with you. What he said was something that's really helped his trading recently is that he's moved away from the market swing trades. And we talked about this a little bit, move to move. Market swing trades are tough when volatility is high, because you tend to see a lot of reversals. And so he's probably looking for a $1 move or a $1.50 move or maybe a $2 move at most. And so he cut out his trades to hold, which is SMB parlance for more intraday swing type trades. And he's been scalping. And so it was very interesting to me that basically the feedback I was getting from him, what he was doing that was working well for him, were kind of the things that I wanted to share with developing traders on our desk, and all the way up to the experienced guys. We've seen struggle from the beginning of October when volatility's gone up. Quite often the general rule of thumb is people's P&L will go up 3x or 5x when volatility spikes if you're a short-term momentum trader. And we've seen some guys have some really good days, and I think October, some people had some really big months. But since then, I've seen a lot of struggle, in particular trading the market. And I think part of it is the feedback that we got here from this is someone with 5+ years of experience, was he was looking for these bigger intraday trades to hold. And what he's found is he's going from move to move. He's trying to understand the levels. He's straight going move to move. And that's improved his results trading more, making these market plays. I wanted to, before we go into the recap, I wanted to show you one more thing, which I thought would be helpful today. So I did a snapshot of the overall view from the day. And you can see the morning, I highlighted that first area where it failed. Those were the 2 short trades in the first 90 minutes, or I guess in the first hour really. And the rest of the day, as we came down, you can kind of see that first bounce from 265, the second bounce from 265. But what I highlighted for you was we established an intraday downtrend. And one of the things that I think really, really can get people in trouble is this fear where they miss the short on the open, then we make a lower high, then we make another lower high, and we're trending lower. And then in the afternoon, they see the market's not bouncing, and we're just above 264. And I think I even tweeted this out a couple of times to kind of highlight where there was a seller at 264.65 for about a half an hour or so. And the thing that you see is people see this bigger trend for the day. They see it's getting down close to 264. We're in an intraday downtrend, but what they forget is we're in a compressed volatility environment, meaning we went from $8 ranges to $6 ranges to $4 ranges, and then today about a $3 range, which is, you got to respect the fact that volatility has compressed. And you have to respect the fact, as we get closer to the end of the day, that you might get one of these wild spike ups into the close. And so if you're shorting at the end of the day, when you see a seller at 264.30 or even 264.50, the risk reward is not great. And you have to be extremely careful to cover the moment it kind of breaks to the upside there, because it can break that intraday downtrend. And in this case, when I did this snapshot of this chart, you can see it broke to the upside, it pulled back again, but it actually held at the breakout area and then tested the downtrend again. And I think I screenshotted this around 3 o'clock or so, but I can tell you into the close, we actually spiked all the way back up to 266. And so if you're that person who was shorting down at 264.50 or 264.30 and you weren't covering right away, you mess your psyche, because number one, your thought process should be, as it's starting to bottom there and gets above 264.65, is maybe I'll capture move to 265.5 or 266 or something like that. We'll maybe snap through the intraday downtrend, kind of close in a little bit higher. It's just not a good risk reward. We were talking about this. I was actually talking about this, Jeff, a little bit as it was happening in real time, as it was happening, and just talking about this is not good. This is not a good risk reward. This is not a good risk reward. And then right in the last 15 minutes, it was just like straight up $1, and we ended up coming in a little bit from there. But it's you need to be thinking, again, forest through the trees. The micromanagement, sometimes you're like, oh, it's weak, it's weak, it's weak, and you're shorting into the bottom. We've already gone down over $3 for the day. You know what? Sometimes it works, but it's unless it's holding below the low of the day, that's really the only.
And it's not a singles or double trade. You're trying for a home run at that point.
Yeah, because the risk reward isn't good, so you really have to get the home run.
You have to get the home run, yeah.
So anyway, I wanted to leave you with that point, and then I'll give you the recap. So before the market opens, have your expected range. We talked about how to do that based on the recent kind of volatility. Are we in a compressing situation or an expanding situation? Only use the tape at important prices that you have identified, both from the open and before the market is open that day. Those key prices, that's when you're using the tape. Scale out of your trades to cover risk, we talked about. And then finally, step back after the open and assess the day overall, which we just did with that chart, which was after the first couple of hours, sellers were in control. And so middle of the day, 50 cent to $1 spikes into prior areas that acted as resistance, or prior support becoming resistance, that made sense to short into those pops. And vice versa, after looking at it after 2 or 3 hours, if it really was buyers in control, then we would be buying into those spike pullbacks after the open. So that's it in a nutshell. I hope this helps you manage some of your market trades a little bit better, and we'll keep these videos coming.